Of all the things that could derail the pensions market in 2020, I doubt a global pandemic was high up on anyone's list. And yet, following a turbulent 18 months for markets, hundreds of thousands of people are facing the prospect of revising their retirement plans in 2021 and beyond. Some are having to work longer than anticipated, while others are accessing their pension savings early to bridge income gaps. Analysis by the Institute for Fiscal Studies found 13% of older workers changed their retirement plans as a result of the pandemic. What's more, around 8% of individuals are planning to retire later than planned, with a smaller percentage retiring earlier than expected. Meanwhile, concerns about inflation, recessionary markets, and future tax increases abound. But one thing customers are learning as a result of the coronavirus pandemic is the value of good financial advice, a focus on fees, and the need for investment simplicity to reach end goals. I'm here with David Marchant, Chief Investment Officer at Canada Life, to discuss what all of these challenges mean for those investing for retirement in 2021. David, thanks for joining us today.
Delighted to be here, Tom.
So 2020 will go down in the history books as the year of the pandemic. But as we move into 2021, and even while vaccines are being rolled out, economies are still slowly recovering. As we're hopefully heading towards, a kind of normality now, how do you expect economies and markets to behave going forward?
Well, I think if you look at the UK, we're seeing quite a sharp recovery. Even in lockdown in the first part of this year, I think consumers and companies had adjusted their behaviour, so they were less impacted than they might have been the previous time. So we've seen less damage from this lockdown. We are now seeing the benefits of some very good decisions around the acquisition and rollout of vaccines, which is allowing us to unlock the economy. And it seems that there is a release of a lot of pent-up demand. There's a lot of savings from the consumers. There's a lot of investment that could have happened last year that didn't, that companies need to make. So I think we are seeing the so-called coiled spring recovery coming through this year. Now, the question is how that impacts on markets. Now, superficially, it's very positive, but markets are very forward-looking. And of course, if you look back to 2020, that was a great year for asset prices across the board. No sooner have we got the pandemic than markets started discounting the recovery. So we had a fantastic year last year. A lot of good news is already priced in, and of course, a lot of the growth we saw in assets across the board was liquidity induced, thanks to the policies of central banks across the world to inject liquidity into the system, and that's flowed into asset prices. So whilst I think we are looking at a very good recovery, the impact on equity prices, I think, is perhaps a little bit more uncertain. I'd be a little bit more cautious as to the outlook there, given where we've come from and given what's likely to happen later in the year for liquidity.
And how concerned should investors be about the massive amount of debt being built up and the possibility of rising inflation in 2021?
Well, of course, we've only just started to recover from the rise in debt that we saw in the 07-08 crisis. And this time round, the UK debt to GDP has gone from 80% to close to 100% through the pandemic. That is a concern. The good news for the UK is that the cost of servicing that debt is extremely low and is actually falling. And if you look at the cost of interest payments to GDP in the year to March, it was about 1.1%, and that compares to 1.7% last year. So that is in decline. That's very good news, as long as interest rates stay low. The other good news is that the average maturity of UK debt is longer than most other developed nations. It's around 14 years, and that compares with around 6, 7, 8 for France, Germany, the US. So we've got time on our side. Costs of servicing the debt are low, and hopefully we can manage to grow our way out and reduce the debt over time. So it is a concern, but I think we can manage that. Turning to the second part of your question, inflation, I think that's the big question that markets are having to deal with at the moment. It's a big challenge for policymakers. We saw, quite rightly, big expansion in monetary policy last year. It's been extremely loose to support the economy. That's been good, but of course, the money impacts both demand and inflation, and we are starting to see some impact on inflation coming through. Part of that is liquidity, part of that is also pandemic induced, where we saw some impact on supply chains across the globe. So we're seeing rises in the prices of commodities, computer chips, ship containers. We're even seeing prices in second-hand cars start to rise. So we are seeing signs of inflation, and policymakers have to make that choice as to when to start to reel back the loose monetary policy. They don't want to do it too early and derail the recovery. Do it too late and they can get inflation taking hold. And it's a very fine balance that I think they're facing, and that's the reason really why bond yields have seen a sharp increase so far this year.
And what about the search for income in a low return environment? What challenges or opportunities are there for retirees?
Well, actually, I think it's got better over the last 6 months. So, we saw dividend cuts coming through last year. As we enter the recovery, the outlook for corporate profits is improving. So I hope that we can see better dividends coming through. Also on the property side, the property market in the UK has been a pretty disappointing area to invest. But now that we are seeing the recovery, we're seeing tenant demand start to improve, feeling a little bit more confident about the stability of property values. You are looking at some quite high yields of 4-5% in the property market. So I think there are some attractions and possibilities there. However, I would caution that there's no free lunch in the investment world, of course, and you've got to balance the low risk certain income with the higher risk higher income and the potential for volatility in that income.
Which investment opportunities or risks would you highlight for those at different stages in their savings? Those saving for retirement, approaching retirement, or during retirement?
Well, the good news is, of course, everyone is living a lot longer. The bad news is they don't have the generous final salary pension schemes that many others that went before us have got. The solution really, I think, is you do, whatever stage of life you're in, you need a diversified portfolio, but it needs to be aligned to your appetite for risk. I think there are some general principles, whether you're young or even as a retiree. I think you need to focus on keeping it simple. Complexity adds costs. You need to focus on costs. Costs erode returns substantially, particularly if you're young. You have a big impact on your portfolio return. And you need to think about how much risk are you prepared to tolerate? How much volatility are you comfortable with? For young people, I would say I think you need to, again, you still need to keep it simple, focus on costs, but I think you can embrace risk. You can take more equity risk. Volatility when you're young and investing is a good thing. Of course, you need to start early because we've got to finance a longer retirement. And you need to save regularly to take advantage of that volatility. For someone older, for a retiree, then I think there is a need for a guaranteed income, but also there's still opportunities to invest, and we're living longer. Inflation can erode that guaranteed income, so we still need to invest for growth, but our tolerance for risk is perhaps lower. And particularly as we're likely to be divesting from that portfolio, we want a lower risk profile fund to invest in than if we were, say, younger. And as you migrate from younger saver to retiree, you need to modify that risk profile as you go through it. But very simply, diversified, focus on cost and keep it simple and think about how much risk you can tolerate.
Brilliant. Well, thank you for your time today, David.
Delighted to be here.